And now it's time for Development Debates, where we explore some of the questions shaping the future and present of China. Today we are talking about issues surrounding Alibaba's IPO. Some people think there is more than meets the eye. Alibaba's IPO is major business news to say the least. The company will offer shares around $60 to $66, ultimately giving it a valuation of over $160 billion. But the Alibaba situation is slightly different. As a Bloomberg article pointed out, Jack Ma, Alibaba chairman, is taking a page out of Google and Facebook's playbook. Ma recently announced he plans to place investors third on his list of importance. Really, perhaps fourth, because he seems to have left himself off the list. He, like Facebook and Google, wants to put customers first, employees second, and shareholders third. Although this could be difficult to understand, he does have a point. Ma does not want to succumb to short-term investor pressure. He hopes that if he treats customers and employees properly, in the end he will have a successful company. And a successful company is good for investors. This public offering is a step to help expand out of China. In China, there are 632 million internet users, and they generate 90% of sales. But as mentioned in an article on Bloomberg Business, Ma hopes to expand the boundaries of business and use internet technology to help solve social issues. Alibaba hopes to employ a model that makes business easy anywhere. In a very humanitarian statement, Ma points out that in the past, Chinese business have focused on how much they have changed China. But now perhaps it is time to bring progress to the world. Furthermore, Ma sees Alibaba's public offering as another way to bridge the gap between the East and the West. He recognizes Alibaba will face a lot of criticism, but hopes to sidestep this and create constructive debates, in the end adding new perspectives to globalization. But not everyone agrees this public offering will be as wonderful as media outlets have hyped it up to be. An article from MarketWatch.com presents another aspect. The article explores Ma's track record from taking private assets public. The best example would be the much forgotten to the rest of the world Alibaba's unsuccessful entry into the Hong Kong Stock Exchange in 2007. One could believe Ma used the time-old Asian tycoon tactic of selling high to the public then buying back low. Alibaba's Hong Kong listing was timed when the Hang Seng Index was at a record high and was considered the largest IPO since Google. But after only a year, the shares had dropped 55% in value. Then, in 2012, after a trading scandal and disappointing financial outcomes, shareholders got their money back as the company privatized and matched the IPO price. So Ma's goal of wait for long-term results perhaps has little meaning to these previous investors. To further give an idea of how these investors got the short end of the stick, this MarketWatch article explains Baidu and Tencent's strategies. Baidu and Tencent founders Robin Li and Pony Ma are just behind Jack Ma on China's billionaires list. The main difference, however, is these two internet company investors became wealthy alongside their original shareholders. This can be attributed to the fact that Tencent and Baidu use their listings to expand. In this way, they align the interests of minority shareholders and insiders. Conversely, as Alibaba has grown, they have dispersed its business between public and private. Investors who gave money to Alibaba.com in its IPO only heard growth in developing businesses, but remained outside the listed entity. Interestingly enough, Alibaba is only listing in the US because Hong Kong would not agree to their terms. Alibaba insists their management board keep control regardless of a minority share. So it is easy to see why many investors hope this time around Ma has their interests at heart, even if he claims they are third.